Hello, my name is Matthew Bell, and today I want to talk to you a little bit about tax-qualified, employer-sponsored, defined contribution retirement plans. That's a mouthful. But I hope that by the end of the video you'll have a little bit better understanding of what these terms mean, and so let's kind of dive in. If you do find something of use, I ask you please just subscribe to the channel or like the video or do both. It really helps in terms of trying to get the channel, give the channel the traction that I'd like it to have to try and get this information out to as many people as possible. And I should say right from the beginning, this video is for general informational and entertainment purposes only. I cannot give you financial advice. I can't give you legal advice. This video is not intended to give specific advice at all. It is simply an overflow of my investigations and the things that I've learned, and I'm simply sharing them, again, just for general purposes. So as we move forward, I want you to keep a few things in mind, and I'm going to explain them more fully here in just a moment. But the first thing is that we're going to talk about how these accounts, these tax-qualified, employer-sponsored defined contribution plans, and we're talking here primarily about the 401k, and then in later video I'm going to talk about the 403b, and then in a subsequent, after that video, I'll talk about the 457b plan. When we're talking about these plans, it's important to understand we are mostly talking about plans where you are going to have a tax-deductible contribution. You're going to have tax-deferred earnings or growth in that account, at least potentially. And when you go to take the money out in retirement, you're going to be taxed as ordinary income. So these are tax-advantaged vehicles for retirement savings. And again, I hope to clarify a lot of that as we move forward, so bear with me. Now, the first thing I'll say is where the names come from. So when we're talking about, in this video, 401k, or in later videos, 403b, 457b, those names actually come out of the Internal Revenue Code. So if you go into the Internal Revenue Code and look up Section 401, subsection K, you'll find the relevant portion that describes the workings of the 401k, what has come to be called the 401k retirement plan. So 401k is simply a reference to the tax code, and same thing with 403b, and so on. Now, another important thing to understand right from the beginning is that these accounts are different from the kinds of account you might set up in a bank for your savings purposes or something along the lines of this. Namely, these accounts and retirement accounts in general are often referred to either as trustee accounts or as custodial accounts. The 401k is an example of a trustee account, and what that means is that you don't have unfettered access to the money that's in that account. You can't just do what you please with it the way you might be able to in a savings account, where you can just put money in and take it out as you please. There are rules governing the use of that, and part of the rules are determined by the Internal Revenue Service, and again, in the relevant portion of the Internal Revenue Code. But there are also other laws that the legislature might pass from time to time, and one that's of great importance in this discussion is going to be the Employee Retirement Income Security Act, or ERISA, and that was enacted in 1974. So that, together with the Internal Revenue Code, are going to basically determine the rules for the 401k. And so here when I opened the video, I said it's tax qualified, and then so on. So what does tax qualified mean? Well, the basic way that I understand this, the easiest way I think maybe to get a grip on what that refers to, is just that a qualification here simply means that there's a special agreement with Uncle Sam. So to be tax qualified simply means that the Internal Revenue Service has created a special relationship with an account that has a tax qualified status. There's just a special agreement. It's treated differently. It's treated in a special way. So again, contrasted with a savings account, it's not tax qualified. The IRS does not give it any privileged status or a CD, a non-qualified CD. Tax qualified refers to a special arrangement with Uncle Sam. Now, number two, I called it employer sponsored, and I'm going to put an asterisk here, but in the for the most part, these plans are employer sponsored, at least in this sense, that you have to gain access to them through an employer. You go through your place of employment, and if they have a 401k set up, then you have access to a 401k. So by employer sponsored, I basically mean that you get access to these through your place of work. I also said that they were defined contribution retirement plans, And this basically means that the amount you put in and the amount your employer puts in, there are certain rules, or if you want to call them guarantees, that are around the contribution. So for any retirement plan, basically you are putting money away now for use later on down the road. So you're putting money away now, you're contributing to it now so that you can use it later. Well, when you use it later, we call that the benefit or the distribution. So the money you put in now is the contribution, and the money you're going to use later is going to be the benefit or the distribution. So in the past, employers had defined benefit plans. They had plans that guaranteed you a certain payout usually for a certain amount of service, a certain amount of income. There was an actuarial calculation that was done, and it determined the amount that you would get in something like a pension. So those are defined benefit plans where your employer says, you know what, if you've worked for us for 25 years and you've been making $100,000, we are going to guarantee you $80,000 in your retirement, whatever. 401k, on the other hand, and these other plans are defined contribution plans, meaning the employer, to the extent that the employer participates, and we'll get to that in just a minute, the employer does not guarantee what comes out. They guarantee at most what will go in. So they basically say, for example, if you put in a certain amount, let's say 6% of your check, we will put in 4% and match you, and that 4% is what they guarantee. They guarantee to put in 4% if you put in 6, let's say. And to get the plan specifics, you're going to have to contact your own plan administrator, your own custodial department, your own human resource department, what have you. Now, we talked about tax qualified, meaning there's a special arrangement with the government. We talked about the IRS code, and we also talked about ERISA, the act that Congress passed in 1974. And those two pieces of law basically determine the rules around a 401k and similar plans. Now, there are three basic areas, let's say, that these rules speak to. The first is going to be putting money in, that's the contribution. The second is going to be the earning period, while the money is just sitting there. And the third is going to be the distribution or the benefit period. So let's take each one of those in turn. I am going to be giving you a view from 30,000 feet, meaning I'm going to give you a view of things that isn't going to get really heavy in the details. So for later videos we might get further in, and for more detailed information you might have to consult written resources. You can check out the website and other things. However, I'm going to keep things pretty general. All right, so the in period. The first thing we should say is that some 401ks plans are going to have rules regarding when you can even start contributing. Some employers may not allow you to contribute when you first begin employment. You might have to wait a year or so before you even have access to the plan. Once you have access to the plan, there may be vesting periods that are applicable. I go through some of these terms, I should say, in another video more in depth, but vesting is basically the idea of how much ownership do you have in the money that's in the account. Now, for ERISA plans, I believe they're required by law to have you be 100% vested in your own contribution. So any money that you put into the plan is your money. That doesn't mean that you have just unfettered access to it at any time, and that's part of the whole scope of things that we'll be looking at here, but it does mean that that money it cannot be taken away from you. It could be lost in the market, that's not the same, but it can't be just confiscated by the employer. Now, on the other hand, the employer may put in some money, as we said, in what's called a match, and whether or not you have access to that money may be a function of how long you have been with the company. So there are certain service requirements. Maybe you have to be with the company for 5 years before they'll allow you to have full access to the match money. So if you sever employment ties, let's say within 2 or 3 years, and you have some money in the 401k and some of that money has been put in by your employer, it's possible that they may not give you access to that money, and it depends on how vested you are in the 401k. For details, contact your plan administrator. Now, employees can contribute to their 401k. There are legal limits in terms of how much money can be put in. In this year, in 2019, the limit for a person contributing who is up to age 50 is going to be $19,000 a year. Last year it was $18,000. It's subject to change and may go up based on cost of living. I guess it could go down in principle, but you would have to check. So if you're watching this video, you probably want to check on what the contribution limits are. Don't take it for granted that all the information here is current, but take it that there are limits to how much money you can put in. Now, if you are over the age of 50, and this is defined as you have your 50th birthday sometime in that year, by December the 31st basically, then you have access to what's called a catch-up provision or a catch-up contribution. And that's to say you can put in an additional, this year you can put in an additional $6,000, so 19 and 6 brings you to $25,000 if you're over the age of 50, 19,000 if you're younger than the age of 50, and that is the maximum you can put into a 401k plan, at least in the year 2019. Now, terminology, these contributions that you make sometimes go by different names. They can be called elective deferrals. They can be called salary reductions. They could be called payroll deductions, or some combination of those terms. And the idea here basically is that you don't see this money. It is owed to you. The employer is taking it from your paycheck and diverting it. You're electing to have it deferred or deducted or moved over into your 401k, and you're not seeing that money when you get your paycheck. So if you choose to participate in the plan, that money is going to be taken out by the payroll department or whatever and sent immediately to whoever is the trustee or whatever. And usually, I should say, that the companies that hold these 401ks are mutual fund companies, because mutual funds form the primary investment vehicle that most people use when they choose to put their money in a particular investment in the 401k. It's often mutual funds, and so mutual fund companies are the ones that actually generally hold these accounts. But you don't pay tax on that money either. So the money when you receive it. So the money that comes to you, this is when we call it pre-tax, meaning that you don't see it and it actually goes into your 401k, and then you get a deduction for that amount that you contribute. So simple example, and again, this is going to abstract away from some of the details of the tax situation in this country, but let's say you make $100,000 and let's say you contribute $6,000 to your 401k. Well, then all other things being equal, we're not talking about any other kind of deduction, you would be able to subtract $6,000 from the gross income amount of $100,000 to arrive at adjusted gross income amount of $94,000 if you made a $6,000 contribution to your 401k. So making a contribution to the 401k brings down the amount of income that is counted for tax purposes, at least the year you make it. So another way of saying that is that, besides saying that they're deductible, another way of saying it is that they are excludable from your gross income total. Now again, employers can make matching contributions, and when they do that, there's actually also a limit on the total amount of money that can be placed into the 401k. So you yourself can place $19,000 or $25,000 depending on your age, but the total amount that can be placed into the 401k in 2019 is $56,000. There can also be some profit sharing features and other things that go along with a 401k, and some companies have this and other companies do not. I should also say the catch-up provision is allowable by law, but some 401k plans do not permit the catch-up provision to be utilized. And so it's not a requirement that they allow it, but it is a possibility that they might. So check with your plan administrator. All right, now we talked about some of the ways of putting money in. Let's talk about the second section of that, and that is how money is handled once it is in the account. So in that middle stage where it is hopefully earning something. First thing that I should say is that when the money is in the account, you as the 401k plan participant are going to have the ability of choosing what kinds of vehicles you want your money invested in. Usually you're given an assortment of mutual fund choices, and you may select them based upon things like how risky they are, how much growth potential they might have, and those are probably rated as such by the mutual fund company that is offering them to you. But it is your responsibility at the end of the day what choices you make, because the investment portfolio has no guarantees attached to it. You can lose, you can fail to earn anything, and you can even have negative returns, meaning you can actually even lose the principal, the money you put in. So the 401k has no guarantees on it at all. Now, having said that, when you talk to a plan administrator, they're very exuberant and confident that over the course of the life that you have money in their account, your money is going to grow, and they often will throw out figures about what they think those growth rates are, and they're going to depend on, of course, they're going to depend on market, but they'll also depend on how risky you feel comfortable with your money being. So different accounts have different potentials for risk. Generally speaking, the greater the potential is for growth, the greater also the potential is for risk. And the less risky an account is, the less potential it has for growth. That's generally the case. But from a tax standpoint, the earnings that are in that account, theoretically, and it is capable of accruing earnings, the earnings are tax deferred. So what that means is that, let's say you put $6,000 into your 401k, and let's say it earns $400 or $500 in a particular year. Well, at the end of the year, you're not going to receive a 1099 form from the IRS. Rather, that money is just going to sit, and it's going to grow and hopefully continue to grow, and then you will be taxed on everything when you go to take it out in retirement. And we'll talk about that in just a moment. But before we do that, I should say take it out in retirement does bring up a question, and that is, what is retirement? What is it? And interestingly enough, there's at least 3 different concepts that I've been able to locate. So the first concept is a kind of common sense or everyday speech notion where retirement is just where you stop going to whatever 9-to-5 job you've gone to for the majority of your adult life, whether it's the same employer or not. Whatever your 9-to-5, and I'm just saying 9-to-5 if you have a less traditional job, you just fill in the blank here mentally, but for a lot of people that's going to be a 9-to-5, and they go to that 9-to-5 job, and then once they're done with that, once they have stopped going, they call that being retired. Well, I mean, in principle, you know, a person could just stop going to their 9-to-5 job at the age of 45 or the age of 50, at the age of 60. Whenever they do that, if you think about retirement in terms of ceasing employment, then you could retire potentially at any age. But from a standpoint of retirement accounts, the situation is different. The second idea for how to define retirement actually comes from the Social Security Administration. So on this conception of retirement, retirement age would basically be framed around what they call your normal retirement age, your full retirement age, or the like of this. And for most people, this is going to be 65, 66, 67, somewhere in that bracket, depending on when you were born. And so if you think about your retirement as being coincidental with normal or full retirement age, then that would be the time when you would have full access to your primary insurance amount. Then the point that I would make is that that might be different from just stopping your day job. So the idea that stopping your day job is necessarily going to be is necessarily going to line up with when the Social Security Administration's benefits kick in is something that you have to plan for rather than count on. But the third conception for retirement then is going to come right out of our discussion of the 401k and other tax-qualified retirement plans, whether they're employer-sponsored or not. And we'll talk in future videos about the traditional IRA, the Roth IRA, and some other vehicles that can also be used for retirement purposes. But when we're talking about those vehicles, a number of them are going to be susceptible to some of the requirements, or they're actually going to have to submit to the requirements of ERISA, as we were talking about earlier, the Employment Act that was passed in 1974 that had to do with retirement savings. And the idea here is that you cannot access your money without a penalty until you are aged 59 and a half. And so the third conception for retirement would be that period of time that you're considered in retirement from the point of view of being able to withdraw or to have distributions, take distributions from your retirement accounts without incurring a penalty. So you can see that these numbers can come apart. You might quit your day job at a particular point in time, and then down the road you might be able to withdraw from your 401k, and then further down the road you might be able to take your Social Security benefits, or you might quit your day job at the same time as you take your Social Security benefits, or there's any number of ways in which these different conceptions of retirement and these different timetables might either converge or diverge from one another, and you're going to have at least some thought given to how these numbers might dovetail or might come apart. Now, we've talked about money going in, the contributions going to a 401k. We've talked about tax deductibility. We've talked about the earnings, how the earnings on the account, if there are any, are going to be tax deferred. Now, the third aspect to this, though, is going to be what happens in the benefit period. What happens when you're taking distributions from the 401k? How does that go? Now, before I say something about the benefit period or taking distributions, let me make a point of clarification, and that is when I say that if you are younger than the age of 59 and a half, then in some cases taking a distribution from your 401k is going to leave you open to a penalty. I do have to make a distinction between a penalty and the normal tax liability. So anytime you take money out of a 401k or any type of retirement plan that is tax qualified in the way that the 401k is, then what you're going to have to do is pay taxes, no matter what. You cannot get 1 cent out of your 401k without paying taxes on it. And the idea would be that it'd be difficult to pay taxes on a cent, I guess, but basically the idea is that from the point of view of the Internal Revenue Service, right, they're giving you this as a retirement vehicle, so they're saying, hey, we're going to give you certain tax breaks when you put the money in and when the money grows, but then in retirement, that's when you're going to actually have to settle up the tax debt. So you don't discharge your tax debt entirely or avoid it, you just kick it down the road. So you're dealing with it in retirement instead of when you're in your working years. But the penalty is something different. So the penalty is assessed for what's called a premature or an early withdrawal, and what that basically means is if you take money out of your account before the age of 59 and a half, then you might leave yourself open to a 10% penalty, and that penalty is charged in addition to whatever tax would be owed. It's sometimes called an excise tax, but that penalty would be assessed on whatever the taxable amount is that you are withdrawing. Now, there are some exceptions to the 10% penalty. There are certain occasions where for example, you might need money to have to pay deductible medical expenses, and or you encounter some kind of a hardship. There are exceptions when the person for whose benefit the 401k exists dies or becomes permanently disabled. There are exceptions for things like rollovers and direct transfers where you don't actually touch the money. You just start taking it from the 401k and pipelining it into something else like another 401k plan with a new employer or a traditional IRA. But if you try and take money out of the 401k just for, you want to take a vacation around the world, or you want to buy a boat, you're going to pay, in addition to the tax, you're going to pay a penalty unless you can show that that withdrawal is and satisfies the Internal Revenue Service's definition of what constitutes a hardship. So now in the payout or in the benefit, the distribution period, the distributions are 100% taxable in a 401k type vehicle. And when you think about it, the reason for that is, of course, that you got a tax deduction when you put the contributions in, so you didn't pay tax on the contribution. The contributions have hopefully grown, they've earned something, and you haven't been taxed on that yearly. So that entire block of money, whatever is in the 401k, is 100% taxable. That doesn't mean it's taxed at 100% tax rate. The fact of the matter is the tax rate is going to depend on your income level, whatever tax bracket you're in, because distributions from a 401k are going to be taxed mostly as earned income or as normal income in whatever year you take the distribution. So you're going to report that on your IRS form. You generally get a 1099-R for retirement income, and you're going to basically report that income as earnings in whatever year you take it, and you'll pay tax on it at that time. If you're over the age of 59 and a half, then there's no penalty. There's just the regular tax burden that you would incur. So at the age of 59 and a half, you may start taking your money. Now there's another facet, and that is that at the age of 70 and a half, you must start taking your money. So at 59 and a half, you may start taking it. At 70 and a half, you must start taking it. and the Internal Revenue Service calls that a required minimum distribution. And at 70.5, that is going to be something you have to start to do. And basically, you're going to have to take that distribution by April the 1st, the year following that year in which you turn 70.5. And if you don't take it, then the portion that you should have taken is going to be assessed a 50% penalty. So you definitely don't want to get into that penalty. And the whole idea, again, is that the IRS basically says, look, we've given you this account for your retirement, and if you haven't started drawing on it by now, you're going to have to start drawing on it. They're going to require that you start settling up some of the tax on it at that age, at 70.5. Now, one other thing about the early withdrawals is that in some cases 401ks are going to have policy loan provisions which are going to enable you to access some of the funds as a loan rather than as a distribution. And the differences are going to be at least twofold. The first, or actually they'll probably be threefold. The first difference is going to be you're not going to be penalized if you're before 59.5, so maybe that's a plus. The second one is you are not going to have to pay tax on it at that time. Again, a plus. The negative there is similarly multiple. You're going to have, number one, you're going to have to realize that those loans are going to have interest charged against them, and so you don't want to leave your account in a deficit. And the second thing is there's what's called sometimes an opportunity cost, meaning that when you start to touch the money in the 401k, you have to realize that you're giving up the money-making potential of that money, whatever it is. And there's no guarantee that it's going to have some particular money-making potential unless it's in some kind of a fixed interest thing. And even there, you can't guard against certain bank failures or S&L failures or whatever. But the point is that if you take money out of your 401k, you're going to be giving up. You're going to be removing that portion, and so it's the money in the account is not going to compound as quickly as it would have with that money in there. Now, in future videos, like I said, I'm going to talk about the 403b, the 457. 403bs are mostly nonprofit, and the 457 is often going to be found in certain government, state and local government jobs. But they're going to be very similar to the 401k in terms of how they function, but we'll get into those similarities and differences in another video. The 401k, of course, is going to be offered again by mostly for-profit private companies, and it's a very common plan, so it's the one I decided to start with. Very common. It's often the case that the employer will often offer a match. So the participation rate in terms of employers that offer the match is fairly high compared to some of the other plans where they may or may not offer a match. Again, the 401k offers numerous investment options. It's typically held by a mutual fund company, so many of the options are going to revolve around various mutual funds. There may be vesting requirements. There may be limitations on when you can begin funding the program. There may be limitations on when you can claim the employer match amount as your own and exert ownership rights over that. That's called vesting. Of course, there are annual limits to how much money you can put in. And usually these plans are going to be limited to full-time employees. There are a couple other plans that might be open. A 403b is sometimes open to part-time employees as long as they work more than 1,000 hours. And in addition to that, the 457 is open sometimes to contractors as well, but the 401k generally you have to be a full-time employee of whatever company it is that offers the plan to participate in it. Now again, as I talk about in future videos some of the other plans, we're going to see some differences, but mostly all of them are going to have the same 59.5 rule where you're going to have to be 59.5 before you can access the money without a penalty. They're mostly all going to have this feature of being tax advantaged when you're in the contribution and earning period, and then you're going to have to pay taxes when you start taking distributions. The ones we're going to talk about in terms of the 401k, 403b, 457 are also going to be susceptible to the required minimum distribution, which is to say that you're going to have to start taking money out at 70.5 to start satisfying some of the tax that has been deferred all those years. Loans, again, on the 401k are often permitted. You can do rollovers and direct transfers. There may be limitations on this while you are still actively employed, but for example, if you leave an employer and go to another job, you may have the ability to roll over or transfer the amount of money from your previous 401k either into your new plan at the new employer or into an IRA that you have through some other company. In general, the 401k is used to build up a nest egg, and the very final thing I just want to conclude with here is that in the 1970s, when the 401ks were first becoming a thing, the idea got formed, and it's been referred to as the three-legged stool. But the idea basically is that the 401k, as your personal private retirement savings, was supposed to supplement two other things. And those two things were pensions, basically, that you would get through your employer. In other words, the defined benefit plan that we were speaking about previously, and Social Security. So in this era here, I'm doing this video in 2019, it is the case that fewer and fewer companies are offering pension programs or having these defined benefit plans. And so more of the retirement planning onus sort of falls upon you. And you have to realize that, because it was the case in the past that simply working at a particular company for a particular length of time was going to guarantee you a certain paycheck in retirement. And again, it might be a cut over what you were making. If you're making $100,000, maybe the pension's only going to pay you 60 or 80 or something, but it was a guaranteed paycheck. I just saw a recent article published by Bloomberg, that said basically that half of Americans have no retirement savings and are going to have to depend on Social Security. So 50% of American retirees are in a position of having nothing put away in any kind of 401k, IRA, nothing. And so they're going to be 100% dependent, many of them, on Social Security. A few of them, minority, are going to have access to pensions, but in some cases those pensions there might be meager, and in some cases the companies that administer those pensions might be in questionable financial straits. So it's by no means a case that all pensions are questionable, but my point is simply that the three-legged stool, this idea that your retirement could be propped up on the employer's pension, Social Security, and your personal savings, because of the questionable nature of the pensions, and even in some people's minds Social Security, a lot is going to fall on that 401k, or in general I should say it's going to fall on your own plans for your retirement. So your plan for retirement might include a 401k, but I would encourage you to look at the options that you have and make sure that you realize a lot of your retirement planning is going to depend upon you and the decisions you make. So take a look. Social Security Administration, you can see your projected Social Security benefits based on how many credits you have in the system. If you have access to a pension, then check with your employer's program. They will give you estimates as to how much service and how your income will impact the calculation for how much that pension is worth to you. And figure out in retirement approximately what you think you're going to need to live on and what you would like to have in order for discretionary spending, maybe take some vacations in retirement or whatever, and make sure that you are on target to have that kind of income available. Because if you just sort of blindly go through the day-to-day process and you don't have a pension and your Social Security check might be God knows what because you haven't checked into it, you might be in a very difficult spot. I know my mom and my dad both have had that experience, and at different times. And so I simply say planning for retirement is going to take a concerted, purposeful effort on your part. So my dad died in 2016, and he left my mom in a bad situation with respect to their retirement, and he didn't mean to. The idea is I am trying to wrestle with some of these issues. I'm trying to help my mom get into a better place, and I'm trying also to help my children as they plan for their own retirement further off, obviously, but in a way that I didn't have access to. And so in encountering some of these terms and some of the ideas that go along with retirement planning, I was just struck by the fact that there really is a steep learning curve, because a lot of the information is just foreign, and a lot of the vocabulary is not familiar to people. We don't use some of these words in everyday speech, so like tax qualified. And so my motivation in doing this research and making these videos is, number one, to help me to think through these issues with people that I care about, but number two, to record that so that that research might be of benefit to somebody else, and I hope that it will be. I know there's a number of avenues for this, but in some cases, the thing that I have discovered is that some videos seem to define one hard term in terms of another hard term. So it's kind of hard to get traction, I've found, in terms of trying to learn some of this. And so I'm going to try and do a little bit better, at least, again, for the people that I care about. And I hope that something that I've said today may have sparked something. I just want to remind you I am not giving investment advice. I cannot advise you on anything. This is simply for general informational and entertainment purposes. But please, if something was of use to you, like the video, subscribe to the channel. I would appreciate it because it's going to help me with future content. It's going to help with the spread of the information, and I really appreciate your time today, and I look forward to seeing you in a further video. Thank you so much.